Basic concepts in fundamental financial analysis. Think of this video as a crash course that packs a year of finance classes into a single session. You may have opened the brokerage account only to realize that half of the words on the site are practically a foreign language. Sound familiar? Don't worry, this video will break down every key term in simple, clear language, so you can finally make sense of it all. Whether you're new to investing or just want to brush up on the basics, this guide will help you understand financial statements, assess a company's risks and returns, and get a feel for how effective its strategies are. Watch to the end so you don't miss any of the crucial concepts that will help you avoid common beginner mistakes. Key financial concepts. Let's start with revenue. This is the total income a company pulls in over a set period, usually a quarter or a year. Revenue is your big picture look at how much money comes in from both core and extra activities. It's one of the indicators for tracking business growth and scale, as it shows how much a company is making from its sales and services. Net income. This is what's left after all the expenses like cost of goods, taxes, and interest are taken out of revenue. Net income shows whether a company is actually profitable and how well it's working for shareholders. Profit margin. This measures net income against revenue and tells you what percentage of income stays with the company after covering expenses. A high profit margin, that means the company is managing its cost effectively. Assets. Assets are everything of value that a company owns, from cash and real estate to inventory and even patents. These resources are what companies use to generate income and grow. Liabilities. Liabilities are the company's debt and obligations, everything that needs to be paid down the line. This includes loans, notes payable, and other forms of debt. Liabilities give you an idea of the company's debt burden. Equity. Equity is what's left of the company's assets after liabilities are subtracted. It shows the owner's stake and is often a good indicator of the company's stability and readiness for growth. Return on assets, or ROA. ROA measures how well a company uses its assets to generate profit. A low ROA could mean that assets aren't very productive or there's room for improvement. Here's the formula. ROA equals net income divided by average assets. Return on equity, or ROE. ROE shows the return for shareholders. It's like asking, at what interest rate are shareholders' funds working in the company? Here is the formula. ROA equals net income divided by equity. Current ratio. This ratio checks the company's ability to cover its current liabilities with its current assets. CR is a solid way to gauge a company's liquidity and stability. The formula is CR equals current assets divided by current liabilities. Quick ratio, or QR. The quick ratio goes further by excluding inventory and only looking at the most liquid assets. Here's how it's calculated. QR equals cash and cash equivalents plus marketable securities plus accounts receivable divided by current liabilities. Debt ratio. This ratio shows the level of debt a company has compared to its assets. It's a useful measure of the company's financial risk. Here's the formula. Debt ratio equals total debts divided by total assets. Cash flow. This is all about the movement of cash within a company. It's a big indicator of a company's ability to generate cash and manage financial challenges. Companies with a strong cash flow tend to perform better, especially during economic downturns, since they can avoid high financial stress costs. Feeling a little overwhelmed? Stick with us. Hit the like button if you're still here, and let's keep going. By the way, if you're looking for historical data to support your analysis, check out the EOTHD website for a wide range of financial data from around the world. Let's continue. Vertical and horizontal analysis. These two techniques are all about tracking a company's financial trends. Vertical analysis shows each item in a report as a percentage of the total, and horizontal analysis tracks changes over multiple periods. Price to earnings ratio, or PE ratio. The PE ratio tells you if a stock is expensive or cheap and its current market price. It's one of the main tools used to assess how attractive a company is as an investment. Book value. This is the value of the company's assets after liabilities are accounted for. It's an approximation of what shareholders would receive if the company were liquidated. Fundamental analysis helps reveal a company's intrinsic value using the financial statements. Learning these terms and understanding how they differ will improve your overall investment decisions. How many of these terms did you already know? Let us know in the comments. And if you want to keep growing as an investor, make sure you're subscribed. We bring you the kind of knowledge that will help you make better investment choices.